In this video, guys, we're going to look at trading with seasonal tendencies. Stay tuned. Hey traders, a warm welcome to great question this from a subscriber. I appreciate all your questions, comments, all the stuff that you guys do when you're watching these videos. Right, so trading with seasonal tendencies. The question is this: if you've got a seasonal tendency, example is natural gas having a tendency to rise in the winter, the price rise in winter when demand is high and decline in the summer when demand is low. And there's lots of kind of commodities that go in cycles like this based on the kind of season that they're grown, you know, the frost season where there's a winter season from the demand side and the supply side. And there's loads of information on that if you're interested. There's kind of people who are far more analytical about it than I am, and you can get the raw data. But the question is, once you've got that data, so for example, you've got this piece of data here that says, okay, natural gas has a tendency to increase in price in the winter, decrease in price in the summer. That's just a statistical fact that somebody has back tested and presented the data to you. Once you have that, how do you trade it? So my opinion is this, guys, is that if you have this data, and let's say, you know, data's data, and it might not always be the case, like we had the Santa rally is often the case, but then, you know, every so often we get a time when it just doesn't work. So it's not guaranteed money, right? You can't just bet the house on it. But you can say, well, if that's a tendency, do I use it? Do I not use it? So my opinion is this, is that you use it as a filtering process. So you say to yourself, okay, so we're now in winter, for example, we're kind of in January, and we're expecting the price of natural gas to rise. So I want to align myself with the probabilities. So I'm only going to look for longs. So this might not appeal to you at all, but I think this helps you, because ultimately, if statistics show that this is the case, and this is what I'm talking about, like actual back testing, someone said, hey, you know what, the chances of it being up in winter between these months are this. And I say there are proper research firms that do that for you, not too expensive. But if you have that data, then rather than just kind of blindly going long is I don't think makes any sense. But I think using it as a filter and saying, well, if I use that and look for my setup as well, then I've got this extra edge and extra weight on my side. So, you know, let's say the market is kind of chugging, tests the lows, and you go, actually, you know what, it's finding some support here, then I might buy. Then that's fine. If that's your trading setup on its own and you would do it anyway, that's good. And if you add it with this, i.e. I'm only going to trade long, then to me, it's just an added bonus, right? So you've got this statistic that says historically it's going to go up, you find a good level anyway, and then you buy it. Now, what you don't do is start to go short. Now, some people might say, well, I like to be contrarian, and that's fine. You know, if that makes sense for you, that's fine. But if you want to kind of add layers of edge to your strategy, and you know that this pattern, whatever this pattern may be, is a good pattern for you and it works well, and you know that historically there's going to be an uplift and you're actually down here and you're expecting the price to go up here, then why not kind of combine the two? That's just my personal preference, guys, when it comes to these seasonal tendencies. You know, I won't just go out and blindly buy because, of course, as you know, things could fall through the floor before they go back up. You can't manage the risk. And so it's very difficult to do that. Whereas if you're biased to one direction, go, well, I'm not going to look for shorts, I'm only going to look for longs if they set up, and be very clear and specific about what you're looking for, then this to me just adds extra weight, because there's obviously some kind of historical tendency for it. You may as well leverage on it, you may as well utilize it and say, well, actually, if that's the case and it is going to rally up 5%, then if I can find a good long, I may as well take it. And of course, you need to be very careful, I believe, that you don't just get sucked into the trap of believing that that's always going to happen and going long and maybe not using a stop, or maybe being a bit too blasé with your entry and those kind of errors, because ultimately, you know, you can have 4 or 5 years in a row where this doesn't happen and the statistic still shows that it is going to happen. So my point is, this is not set in stone, guys, and you know, it may be very, very limited use. So why not just say, well, you know what, if it is going to work, I may as well align myself on the long side. To me, that makes perfect sense. So you're not ignoring it, but you're not adding any additional weight as such to it. All you're doing is saying, well, you know what, if it's going to work, then I may as well have it on my side than not. So those are my approach, guys, to those seasonal tendencies. Works quite a lot with some of the, obviously the energies and some of the soft commodities. The meats, that kind of stuff, orange juice, frozen orange juice, and what have you. There are some other seasonal tendencies with business cycles and metals and stuff, but I think more the commodities when you've got a supply and demand side that makes sense in terms of the harvesting and all this kind of stuff, and in terms of consumption in winter because of the cold, what have you. So something to think about. Let me know your thoughts in the comment section below. As always, take care, keep your risk managed. Bye bye.